Well, traders, we got past the FOMC and the markets have been a little bit mixed. I'm interested to hear what Jim Welsh from Macro Tides has to say, and that's why I'm going to bring him in right now. Jim, how are you?
I'm good, Blake. How you doing?
I'm doing great. It's been interesting. Well, I'd say 24 hours, since the Fed had their meeting. I know no one was expecting the Fed to actually move on rates, but I thought there was some interesting talking points that are worth mentioning. But before I want to hear what you have to
Yeah.
say, but I do think there's a few interesting things. What do you have to say about yesterday's FOMC meeting?
Well, as you said, no one expected, a cut at the July meeting. I think a lot of people were hoping for some hints that there could be a cut or would be a cut in September. And as I wrote in Monday's weekly technical review, Powell is not going to provide any hints. That he's going to say that monetary policy is in a good place. We can respond to whatever comes up. We're data dependent. Every meeting is a live meeting. And I think Wall Street was expecting to hear more uh, to hang their hat on. And the fact that there were two dissents, as I noted in Monday's letter, I expected Waller to dissent, and there was a chance that Bowman would, and she did. And that's the first time since 1993. But the majority of the Fed members, Blake, are still of the mind that as long as the economy is chugging along, and we're at the doorstep of really seeing inflation uh, come from tariffs. The only question mark is how much, that they can be patient. And I don't think anything has changed. So to the extent that Wall Street was hoping for a hint that, or a leaning, the Powell setting up September for a rate cut, I just didn't think that was coming. I mean, he's just going to stick to the tact he's been on really for a number of months.
Yeah.
And I think that Wall Street was a little disappointed when they didn't get more.
But now immediately after that, we got earnings from Microsoft and Meta, which shot the
Right.
market up basically towards new all-time highs, and then we've seen it sell off again today. So, how important are these earnings that we're getting tonight from Amazon and Apple? Is it something you're going to be paying a close attention to?
Of course. I think, though, sometimes it isn't the news, it's how markets respond to the news that provides more insight. And so you had these two companies do really, really well. Their stocks reflected. They're very gigantic in terms of capitalization. So they're weighting on the S&P is big. Apple and Amazon are, the same boat. But I think, Blake, the bottom line here is we're seeing the market underneath the averages weaken. And it's been going on for a number of weeks now. And that can be maintained when you get this concentration buying in these big, big capitalization weighted companies.
Sure.
But under the surface, I see more and more signs of deterioration. It doesn't mean, oh my God, the sky's going to fall. You really need a strong reason to sell. This is a theme of mine for a long time, is that technicians forget that basic simple thing that Wall Street is long biased, and until they're given a reason to sell, they don't. And so the strength of the selling reason dictates, gee, is it a 3 to 5% correction? Or gee, the Fed's hiking rates like crazy, Trump's raising tariffs like crazy. That's how you get 20% or more declines when a very good reason shows up. And my take has been, I don't see a strong reason to sell materializing just yet. Therefore, a 3 to 5% pullback seems to be a reasonable expectation.
Well, those are very wise words from some market veterans such as yourself. So let's jump into the charts that you brought, and we'll start off with the
Yeah.
GDP swings driven by
Yes.
import swings. So here we
Yeah.
go, and
I
here's your
mean,
first chart.
yeah, I mean, we've talked about this off and on, for really months that we were going to see this kind of action. The first quarter was depressed because companies bought a lot of stuff before the tariffs. And in the first quarter, net trade, Again, just for basic accounting purposes, gross domestic production says we're only going to count stuff that's produced in the US. So stuff that we're buying from overseas and importing, we're going to subtract that from GDP. So, in the first quarter, it subtracted 4.66%. In the second quarter, the amount of stuff we're buying overseas collapsed by more than 30%, and it added 5.18%. So we've talked about this, I've written about this, that you're going to get these big swings. I think looking at final sales is always a better number when you're in this kind of environment. And what we saw was in the first quarter, final sales was 1.9%. So as I said at the time, that the GDP report was overstating weakness in the first quarter because in a sense, final demand was 1.9. The 3% gain that was announced yesterday, Blake, obviously overstates strength because final demand actually contracted to 1.2. So we're seeing evidence that the economy is slowing modestly.
Modestly is the key word there. Okay.
Yeah,
Okay, so the next chart, this is interesting. Tariff inflation. One of the points, in my opinion, during the Fed meeting was I think the reporter said or asked, are you looking through the tariffs for the risk, towards the risks for inflation? And it's something to that effect. And he's like, basically, that's why we're on hold. We're on hold because we are looking through the tariffs and we see inflation coming, basically, is what he
right.
was saying, which seemed
Yeah.
a little bit more hawkish than the market wanted.
Yeah. I mean, because Waller, who dissented,
Yeah.
his view has been, as he's given speeches and during interviews, is that this inflation bump we're going to get is going to be a one-time event, and then we're going to see inflation unwind again. And conceptually, that's 100% correct. What we don't know is how big of a bump. What we don't know is companies that aren't involved with tariffs, are they going to piggyback competitors' price increases due to tariffs by raising some of their prices as well? And so there is a fair amount of unknowns. And again, the bottom line here, as long as the labor market stays okay and the economy's chugging along at about 2%, call it, the Fed feels that we can wait to just see. And part of this relates, and as I've written, Blake, in 21 and 22, the Fed was wrong, badly wrong. Inflation is going to be transitory. They said that for about 6 months until November of 2021, when Powell finally said, oops, it doesn't look like inflation is going to be transitory. And by then, the CPI was like 5.5, 6%. I
Right.
mean, the cat was way out of the bag.
Sure.
And I just think that for some of the folks on the FOMC that went through that, it's like, all right, nothing is pressing us to act in terms of the economy showing signs of weakening. Let's make sure we don't make another mistake. And lastly, and you and I have talked about this, President Trump pounding Powell relentlessly, I think raises it's at a cross purpose because if I'm on the Fed and I think Fed independence is really important, I'm going to be resistant to cut rates until and unless I have definitive data to tell me that it's okay to do that. If it's questionable and we cut rates, people are going to think we caved into the guy. And
Yeah.
so, I mean, and what this chart shows, and the solid black line is the one to focus on. In 2023, goods inflation started to deflate. So the upper blue line is like service inflation that was coming down, but the PCE is a combination of those two categories, goods and services. So we see services continue to creep lower, but what's changed in the mix is over the last 7 months, goods inflation has started to percolate. And about 3 weeks ago, I had a different chart showing goods inflation. I think it was in the CPI or the PPI report. And that was my point, is we're seeing goods inflation. This is where you would expect to see tariff inflation show up. because importers are taking goods from overseas that have a 25% or whatever tariff on it, and it's showing up in prices. So rather than, and you can see prior to the pandemic, we had goods deflation. So this has been a relationship that has kind of been going on for a while, goods deflating, and services, back before the pandemic, being pretty contained. And so this is one of the things that I think Powell referenced in the press conference was goods inflation. So this is why, again, they want to wait and see, is because we are seeing tariff inflation show up in the data. What we don't know is just how long lasting and the magnitude.
All right. Well, you also bring up Trump's wonderful relationship with Powell, and I think it was after we recorded last week's interview when Trump went to go visit Powell at the new Federal Reserve uh,
Yeah.
construction zone area, and that was an interesting. You could just see how 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 strange their relationship is right now, or strained
Yeah.
or strange.
Yeah. Body language and all the rest of it. What's
Yeah.
interesting to me is Mohammed Al-Arian and Professor Siegel in the last week it came out and said, you know what, I think Powell should resign, because it'll preserve Fed independence. I don't know what those guys are drinking, okay? But that to me is back ass words. I think Powell resigning is exactly the wrong message to give. I think it would undermine markets
Oh
and so
yeah.
forth. And again, there's a bunch of people that vote every meeting on rate cuts. And so it isn't just a one-man show. So again, this is after the PCE, which again shows inflation. So we've seen the consumer price index tick up about 3 to 4 tenths of a percent just in the last few months. The PC has ticked up, I think, 2 tenths on the core over the last few months. And we're not really into the meat of tariffs yet showing up in the data. So I just thought, again, this kind of language and so forth is just disrespectful, uncalled for. But, we've all grown a little jaded and used to President Trump saying this kind of stuff about someone who I think is very sincere. Powell is attempting to do a tough job as best he can. So, telling somebody too stupid, total loser, you know, I mean, I get it, Blake. We have $37 trillion worth of debt. And as the government rolls this debt over, the interest expense is going to continue to creep higher from $1.1 trillion. So Powell, or Trump wants Powell to cut rates by 300 basis points because that'll save the country hundreds and hundreds of billions of dollars of interest expense. He's right. At the same time, I think the next chart, maybe it's the next chart. Oh, yeah. Here's what happened last September. The funds rate was 5.37, which is the mid-range between 5.25 and 5.5. They cut it 100 basis points. Oh, look what the 10-year did. On the day the Fed did the first cut, the 50 basis point cut, the 10-year was at about 3.5, 3.6, pardon me. Well, over the next 6, 7 months, it went up to, 4.8,
Right.
100. So the Fed cut 100 and the 10-year went up 120 basis points. So if the Fed should cut 300 basis points, the 10-year may come down a little bit because 300 basis points is gigantic. But I'm not sure you'd see the 10-year come down 300 basis points. So my only point is there's always been a disconnect between what the Fed is doing with the funds rate, which is basically an overnight rate, and long-term yields. And
Sure.
right now, long-term yields have been spooked in recent months by the coming supply, the tsunami of supply coming. And the Treasury on Wednesday said, oh, by the way, we're going to raise $1 trillion in the third quarter and 590 billion in the fourth quarter. Now, the second quarter number was inflated because of the debt ceiling stuff that postponed some sales earlier, but that's a lot of paper.
Yeah.
And as I've noted, yields are going up globally. And countries like Germany is going to run a bigger deficit than they have in a very long time. Other countries in Europe by boosting defense spending. So my point is, we're entering a window of time, Blake, where the competition for money to fund deficits and financing for governments is going to intensify. And normally, if you start to have people question whether or not they want to extend money for 10, 20, 30 years, the only way they overcome that hesitation is by higher yields. So that's in part why longer term, I think Treasury yields are headed higher. I still think the 10 years going to 7.5 at some point in time. And so my point is, President Trump is saying all this stuff, and we just went through an experience where the Fed cut rates and Treasury yields went up significantly. This has never happened before. So these are the things I like to try to pay attention to, Blake, because is it an indication that we have seen a secular shift in Treasury yields after declining from 1981 to 2020?
Yeah.
All of a sudden, we're in a new environment. And my answer, for me, the answer is yes.
Yeah, it's going to be hard to stop that train right now, even with
Yeah,
cuts. I mean,
yeah,
let's face it.
yeah.
Everybody thinks that the Fed, if the Fed cuts rates, let's be realistic here, and let's say, like in your example, well, that's a full percentage point, but let's say it's like 1.5%. Is the 10-year going to reflect that?
It may not, because the other
Yeah.
issue is, normally in a recession, what happens is the Fed slashes rates and long bonds rally like crazy. But people are now so much aware and sensitive that, all right, we're running a $2 trillion deficit with the economy the last 3 years growing at a decent pace. If we go into a recession, that deficit goes from 2 to 3 trillion. There's a risk that we could go into a recession and Treasury yields don't come down, even though the Fed cuts
Yeah.
short-term rates, and instead go up. Think about housing and other sectors that are dependent on longer term rates.
Yeah.
So these, again, I'm not predicting any of this stuff. I see the potential for it happening, and I'm just trying to pay attention.
Okay. Well, what you're trying to predict is the S&P here. So let's see. We have a streak, 68 consecutive closes above the 20-day
20-day
moving
average.
average.
Yeah. So this goes back to 1950. We're at 68 days. I think in 1998 or something it was 78 days, and then way back a long, long time ago was 72 days. As we also know, the S&P hasn't had a net change of more than 1% in, I don't know, 3 weeks or something. So it's been a very quiet market. And as I've noted, if you don't have a reason to sell, it doesn't take a lot of buying to continue to grind the market higher, which is exactly what we've seen. I just wanted to show this chart because the last 2 or 3 weeks, I've been talking about, well, I think we're going to have a pullback, Blake, and it hasn't materialized. So, to me, this is a chart that kind of says, well, what's been going on the last 2, 3 weeks is highly unusual. you know. So again, it just comes back to using tools to try to make investment decisions and skew the odds in our favor, as opposed to tossing a coin. And
Yeah.
so the next chart is one we've talked about, I think, each of the last 3 weeks.
Let me grab
It's
it
the
for you.
S&P 500 and the 21-day average of net advances and declines. So here you can see the grinding higher, and fewer stocks are participating. So that means if the mega cap stocks and Nvidia, which to me looks like it might be completing 5 waves up today, and the semiconductor index, those stocks start to give up a little bit of a ground, the odds are the rest of the market aren't going to step up to offset that weakness. And so, again, historically, when this kind of divergence shows up, you get a garden variety correction of 3 to 5%. If people are given a reason to sell, all of a sudden it's 7 to 10%. But my expectation is 3 to 5% at this point in time, and we'll see what does show up.
Okay. All right. Well, let's see what it does to the dollar, because the dollar is doing what you expected. It's actually got quite a bid here.
Yeah, yeah. We've talked ad nauseum over the last really 2 months or so. Sentiment got very extreme, positioning against the dollar like the worst in 20 years. People are really negative. And all that took place after the dollar was down over 10%. Classic trend following. So again, I think the dollar completed the correction from October of 2022 when it was a 114.70, dropped to 99, bounced to 110, and then dropped to this 96 level. I think that completed a big time correction. The positioning sentiment said, okay, we're going to get a rally. I think the dollar rallies at least to 104, 106. The next hurdle is that 101.97. And we're already a little bit overbought, Blake. So my thought here is that I don't think we're just going to run and take out 101.97. I think the odds are we'll make a move up toward that level, and then there'll probably be another pullback in the dollar index. But longer term, I think the dollar, hit its bottom at 96.37, and I think coming weeks and months, it's going to work its way higher.
All right. Well, I mean, higher. I know in the past you've targeted maybe even, above 110, and I still find that
Bull, yeah, yeah. It's hard to believe, man.
yeah, it is hard to believe. But
Yeah,
hey, look, we've seen weirder things in the markets, right?
yeah, and here's another point. I'm writing the August issue of Macro Tides. One of the things I'm focusing on is Japan and the yen carry trade and the Bank of Japan and what's been happening to yields over there. And you've got this demand for dollars is increasing at a time when the Treasury is going to be selling a lot of paper. Emerging markets have to fund over $8 trillion between now and the end of the year, rolling over and 90% of that, Blake, is dollar denominated debt.
Hmm.
So my point is, historically, there have been instances where a dollar shortage develops. So 2008, for instance, dollar had a huge move in a very short period of time. 2020, huge move, in part because the world is caught short dollars at a time when other players need to have dollars. So if it's going to get to 110, my point is we will see some kind of dollar short squeeze, both in terms of positioning in the actual dollar, as well as the world not getting enough dollars. What prompted me thinking about this is a week or so ago, the Bank of Japan injected dollars into their banking system. In mid-May, the ECB sent out a note to their banks. Hey, what's your status with dollar funding? Because 23% of the funding by European banks comes from the dollar. Then the Bank of England did the same thing a week or so ago. So my point is there's these concerns behind the scenes of, all right, you know, do we have a potential strain on the global financial system from a shortage of dollars? And the central banks are trying to be proactive. Bank of Japan injecting liquidity using collateral as assets as collateral. Well, if you're short the yen and long the dollar and long tech stocks or long treasury bonds, to get dollar liquidity as collateral, that would be the collateral.
Yeah.
So my only point in saying this is just that the chart implies that you could have one heck of a rally. Well, it's just not going to happen out of the blue. There has to obviously be a good reason. And for me, that's a possible reason. Not next week. It may be 3 months. It may be 6 months. It may be down the road. But I find the behavior of three major central banks in terms of asking their banks, what's your dollar funding situation look like? They're not doing that just because, I mean, it's their job to be good supervisors, Blake, but why now?
Right, right. Well, if anybody listening in follows the dollar milkshake theory, this is one of the big risks that Jim's basically explaining is, there could be a liquidity crisis. I remember, during the financial crisis, 2006 to 2007, everybody's just trying to move away from the dollar. The BRICS countries are trying to trade amongst themselves, just very similar to something we're feeling right now. And then when the tide goes out and everybody, you can see who doesn't have their shorts on. I mean, that's just what
Right.
happens, right? So,
Yeah, yeah. No, I
All
mean the
right.
dollar index went from 70 to I think 88
Yeah.
in 2008.
Yeah.
I'm trying to remember in 2014, I thought Mario Draghi, he made some comments about inflation being a problem and the euro strength was causing issues. And I wrote about this specifically in March, April of 2014, Blake, that Mario's basically saying he wants the euro to go down. And the euro was up around 160. I think it ultimately dropped under 120 very quickly. And the dollar had another big move. So policymakers influence currencies at times very significantly.
Yeah.
And I just think that what's going on in the world with the Fed holding the funds rate, it is modestly restrictive.
Sure.
And I've shown charts of this and talked about this. So, the Fed being modestly restrictive contributes to maybe a shortfall of dollar funding.
All right. Well, what does it do to gold? Because gold, as you'd been looking for, has been rolling over. I've been focusing on this trend line, not the one you're looking at. Mine looks more like this. But
Hmm.
regardless, they all look, it's breaking. But the question
Yeah,
is, how far are we going to go down? I mean,
yeah.
it's been one of my cues to be long dollars is seeing the breakdown in gold. It's just, I'm curious about how far you think it's going to go. I think we're going to see 3,000,
Yeah, yeah,
but
yeah.
what do you got here?
But I mean, there is that risk that you take out 31.27 and the next stop is, those highs around 3,000 or just below. My take has been as I think the dollar or gold is forming a triangle. So that initial drop to 31.27 was wave A, 34.46 was B, and we're in wave C, which my take has been we're going below 32.56, but holding above 31.27. So if that's what happens, Blake, it implies that that low for wave C should create a bounce for wave D that will rally go but below 34, that high we just saw, 34.35 or whatever.
Yeah.
And then there'll be a wave E. So we're talking about another 2 months probably of sideways chopping in gold. Sentiment got extraordinarily bullish when gold hit 34.96. It had a heck of a move. And you can, retrace big moves either with a good sized correction or a bunch of choppiness that just wears people out. And so my bias has been, I think that high at 34.96 was wave three. We're in a wave four triangle. And that once that triangle ends, gold will have another shot to new all-time highs.
All right. Well,
But the
let's
key
talk.
is that 31.27.
Okay.
And, you know, taking that out all of a sudden opens the door to 3,000.
Okay. Well, let's talk about TLT because I'm pretty confused about the direction of where fixed income's going, but looks like you're still looking higher, so that means yields would be
Yeah.
lower.
Yes, exactly. I just, the correction, the upward correction from 83.29 in TLT and the spike in yields, I think the 10-year got up to about 480, the 30-year got to 515. So we saw a nice rally. And then look at a three wave in red, A, B, C, and then another move up. So what this implies to me is that this upward correction from 83.29 is wave A up, wave B down, and we're in wave C up, and it should take out that high that we saw at 88.43.
And so then that means we have a D, E, or is it the C going to be the ending because of the
That's my
previous?
guess and my take is I think wave C will be the end of just a simple A, B, C. Now, within the A and B and C, obviously there's a lot of back and forth.
Yeah.
Um, but once that rally, if indeed, and the 10-year gets under 420, that was the where it got when TLT was at 88.43. So once this rally is over, Blake, I think being short bonds has the potential of being a great trade because my take here is that once this rally is over, Treasury yields are going above where they were in October of 2023, which was about 5% on the 10-year in 515 on the 30-year.
And and yours truly, President Trump would absolutely love to see that. That's
What, yields
sarcasm.
go up?
That was sarcasm.
Yeah,
Yeah.
yeah. I mean, can you imagine the tweets that'll come out?
Oh, his
You
his head will explode, and like literally
know.
explode.
Yeah.
All right, Jim. I know it's summer, and I know there's less in the summer. A lot of people are on vacation, they're on holidays. But if you're watching these, just realize that Jim, takes time out of his day, spend it with you. So if you really enjoy these interviews with Jim, give him a thumbs up. Subscribe to this channel so you don't miss these exclusive interviews. And make sure you give Jim a follow on Twitter. I try to tweet this out every week as well. But Jim, how can traders get your most recent issue of Macro Tides?
Send an email to Jim Welsh Macro at Gmail and mention that you're from Trader Summit, and I'll be glad to send that out. And if you're really smart and decide to subscribe, you're going to get a discount.
Awesome. All right. Well, Jim, it's always a pleasure each and every week. Have a good remainder of your week and hopefully a restful weekend. And traders, we'll see you guys back here next week as well.
All right, thanks, Blake.
Thanks, Jim. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.